Welcome to Crypto Prism's channel. Let's take a look at Bitcoin's latest market structure. First, let's start from the current 1-hour chart of Bitcoin. The rebound right now is very weak, and it cannot return back inside the triangle, which is a very critical signal. Price chose to expand volume downward at the end of the triangle. After the breakdown, a typical continuation structure appeared. Breakdown, weak rebound, and then another sell-off. And this rebound did not even reclaim the triangle's lower boundary after the breakdown. This shows that selling pressure above is active, while buyers below are passive. The main theme of the market is still a continuation of the bearish trend. Let's first look at the structure and price action. At the end of the previous triangle, it was essentially a phase where bulls and bears were compressing into a narrowing range with squeezed volume. The real direction choice is usually accompanied by a solid candlestick. We can see that the breakout candle here is a relatively long-bodied bearish candle that directly snatched the price through the lower boundary of the triangle. Although there was a quick pullback afterward, the rebound height was clearly limited, only forming a weak sideways bounce below. And then continuous bearish candles appeared again, pushing the price further down, with lows continuing to shift lower, printing a new lower low at 63,800. This is a standard bearish trend, unable to return into the structure. Lower rebound highs, and continuously making new lower lows. So my judgment is that the downtrend will likely continue. And this view is based on clear structural evidence. From the volume perspective, the breakdown decline was accompanied by expanding volume, while the rebound repair showed clear volume contraction. And during the subsequent decline, volume continued to expand. This is a clear signal of bearish trend continuation. We can look at the MACD. It is clearly in the bearish zone now. The fast and slow lines are running below the zero axis for an extended period, and the green histogram has already converged, while the red histogram is starting to expand. There is no strong bullish crossover to drive a trend reversal most of the time. It is just a technical repair after a decline. As long as price cannot rebound above key resistance levels, this kind of MACD repair is unlikely to expand into a second bullish wave. The RSI is also currently in a weak zone. From the chart we can see it is around 31, which is relatively low, indicating that market strength is still insufficient. During the rebound phase, if RSI cannot rise, it means buyers do not dare to chase and can only passively cover. Although KDJ shows signs of turning, with low-level dulling, this is common in trending markets with low-level stagnation. It only suggests that the short term may pause temporarily, but it does not mean the trend has ended. A true reversal must first see price return above key structural resistance and form higher highs. The first resistance above is a rebound point after the breakdown, around the 66,500 area. Further up is the lower boundary of the triangle, which is also the breakout point if price still cannot reclaim it. Then it is a typical retest for continued shorting, only when price returns inside the triangle and stabilizes above it. Will the bearish logic be invalidated? So, why do I believe the downtrend will continue? Overall, it is because the rebound failed after the breakdown, confirming a bearish retest, combined with consecutive bearish candles and lower lows, and signals of trend continuation. Both volume and indicators are simultaneously bearish. Downward momentum has not truly weakened. In terms of trading rhythm, a trend-following approach is more suitable here. If there are further rebounds, the price still cannot return inside the triangle, then the rebound is more like a better secondary entry opportunity for short positions or a window for adding to positions. What truly needs caution is a high-volume bullish engulfing move, reclaiming the structure and breaking the rebound highs. Only such a combination signal would be the moment bears should step back. Now let's move on to Bitcoin's daily chart structure. We can see on the daily chart, today's candlestick is basically a signal of a bearish showdown. The daily structure here is a typical downtrend. Rebounds fail to break previous highs, and pullbacks continue to make new lows. This high-volume long bearish candle directly broke through the previous sideways buffer zone with decisive bearish pushing. It belongs to a continuation of the downtrend, rather than a bottom formation. A real bottom would require a high-volume bullish engulfing move to reclaim key resistance levels. Now let's look at the volume-price relationship. Today's volume has clearly expanded, combined with this solid bearish candle. It is a very standard high-volume decline, which equals trend confirmation. If this were a shakeout by major players, we would usually see a high volume decline, but a strong recovery into the close, leaving a long lower wick as an accumulation pattern. However, what we see now is closer to a high volume sell-off with a weak close, indicating that market transactions mainly occurred during the downward push, and buying support was passive, failing to effectively push the price back up. This is why two types of movements are likely. Either a small rebound with shrinking volume, giving bears a better second entry opportunity, or a direct slow grind downward, breaking supports layer by layer. We can also see the moving averages are in a bearish alignment, short-term and mid-term. The moving averages are overall pressing downward. Price is running below the moving averages, and the averages form a dense resistance band above, which means every rebound will face trap supply and MA resistance, making the market more likely to move in a pattern of rebound, resistance, and then further decline. Simply put, a bearish MA alignment caps the upside and opens the downside. In such an environment, the daily chart tends to produce high volume medium to long bearish candles, which usually push the target toward previous lows or key support zones, and indicators are also giving the same weak confirmation. We can see MACD is operating in the bearish zone. The bearish histogram momentum is obvious, although there may be temporary histogram convergence indicating short-term pauses. As long as the fast and slow lines remain at low levels, and price has not reclaimed key resistance, nor the moving average resistance zones, then MACD repair is more like rebound repair, rather than a trend reversal. Looking at RSI again. RSI is currently around 30, which indicates very low market strength, and declining risk appetite of capital in a trending down market. Low-level RSI dulling is not unusual. It more often signals that a rebound may occur at any time, but it cannot directly define that a bottom is formed. So why do I think? The probability of revisiting 59,800 is very high. The core reason is that the daily chart has printed a high volume medium to long bearish candle, clearly exposing the weak structure, which is essentially trend confirmation. The candlesticks and moving averages are also in bearish alignment, suppressing rebounds. Rebounds are very likely unable to return upward, and can only build momentum for a second sell-off. Indicators are also running within bearish zones. Short-term repairs are insufficient to reverse the daily trend, so capital is more likely to follow the trend and test stronger support levels below. And the 59,800 level happens to be a previous low, a key support level that the market will naturally test. Next, the chart can focus on two key signals to judge strength and weakness. Bearish continuation would be a weak rebound with shrinking volume, failure to reclaim short-term moving average resistance, followed by another bearish candle and breaking the previous day's low, which would basically target 59,800. A stabilization signal would be if, after a high volume sell-off, price strongly recovers with a clear long lower wick and then continuously reclaims at least one key moving average resistance, such as the pressure zone near MA20 and MA50. Otherwise, any rebound is merely a continuation within the downtrend. Overall speaking, the daily chart shows a high volume medium to long bearish candle, bearish moving average alignment, and increasingly weak rebound structure. When these three factors are combined, it is very difficult for the market to produce a micro reversal, and the subsequent move is more in line with a trend following retest of the 59,800 support zone.